there is certainly a lot more jitters. There are certainly a lot more concerns that are being expressed, and there's certainly a lot more caveats coming from investors, and that's clear. I think where we have to pay attention here certainly is, Sarah Fryer making those comments as the chief financial officer of OpenAI. It does open some very large, doors of like question marks of what is this company thinking and how sustainable is its future for certain.
Today on the Tech Report, I'm joined by Senior Business Editor at Wired, Natasha Bernal. Thank you for talking to me.
Thank you for having me.
Over the past week and a half, we've seen a lot of turmoil, is a good way to put it, in the AI-related stocks. Can you just quickly take us through exactly what's happened and sort of what's coincided with this dip?
Yes, so we've had a series of comments from different people that have subsequently been followed quite quickly by a bit of a dip in the stocks of the publicly trading companies within generative AI. So Michael Burry, whose role shorting the US housing market in 2007 partly inspired the Hollywood film The Big Short, he disclosed $1 billion bet against Palantir and Nvidia. In a series of posts on X, he said that there was an unprecedented amount that AI firms were piling in to data storage and processing power, and that he didn't see that there was going to be enough demand for cloud computing from customers to justify that investment. Speaking at an event in California, again, OpenAI CFO Sarah Fryer said that the private AI company was exploring an ecosystem of banks, private equity, and maybe even government support, which led to big questions as to how the ramp up of OpenAI was going to happen. And then you had big investment giants, Morgan Stanley and Goldman Sachs, saying things that that basically casting, I suppose, a question mark over the huge investment amounts that these companies are requiring to move forward in their ambitious proposal to set up loads of data centers and promote AI and get to AGI. And so I think Morgan Stanley's note was particularly pertinent, at least to this. They were saying that recent speculative deals in generative AI have echoed past risky strategies, and they've raised concerns about sustainability. And they advise basically saying that investors might want to sell small cap stocks in unprofitable tech companies, and they might want to focus on large cap quality stakes instead. They also cast questions, I suppose, concerns that sort of extended their concerns over the valuation concerns that they've been having over these stocks as well. So all of these things kind of saw ahead of a dip in the market where we saw about $1 trillion wiped off of the valuations of these big companies. Obviously, OpenAI is an exception because it's a private company, therefore we don't have the figures. So temporarily we saw a bit of a dip, and that has fueled again, I suppose, the feeling that we might be in a disillusionment trough, as they've called it, and that there might be an AI bubble that is playing out at the moment, and that these companies might struggle to meet expectations from investors and from the market.
So where are the markets now? Because I think there was, like you say, it dipped, and then there's obviously a bit of a bump. Some still remaining low, and I think maybe Palantir is just jumping back up again now.
Yeah, so if you look at the stocks at the moment, a lot of them are kind of, if you look at the graphs, they've gone from ebbs and flows, up and down. They seem to be stabilizing quite well at the moment. I do think that investors will not be looking at sort of short-term movements from the market because they know that this is a longer-term gain. I think they will be looking at sort of things like year to date. So if you look at Nvidia, for example, its stock is up 40% year to date. Meta is up 4.6%. Microsoft is up 21.9%, and Palantir is up 154%. So it's doing gangbusters compared to this time last year. So I think it's very telling that the direction of travel is still positive despite some headwinds.
Do you think that this sort of shock is a temporary thing, or has created a bit more of a bit of a wake-up call or a long-term effect on stocks, and maybe we won't see quite as rocketing increases week on week, month on month?
I think the more we talk about a bubble, the more there is potential for it to be a bubble. And then people are drawing more and more people are drawing comparisons that you and I have spoken about before regarding the 2000 the dot com bubble and what happened in the 1990s, and whether this is something that could replicate now. And again, a lot of people are noticing the interwoven nature of all these businesses and how they rely on each other, how you've got huge amounts of debt piling up, that the schedule to become profitable for companies like OpenAI is still very much 2029, which is in the future, is very far away for a lot of investors, and there's huge amounts of money being doled out, and I think the interesting thing that's happening here is that people are starting to realize that perhaps the amount of debt is a bit of a problem, perhaps the business's ambition without backing is a little bit of a problem, and that perhaps if other investors are interested in this situation and are looking to short or looking to put their money elsewhere, that herd mentality of the market could also be a problem. And so it doesn't matter necessarily whether you or I or any other individual investor believes that there is a bubble or not a bubble, or whether it is something that is going to come crashing down at some point. If enough people do believe it, it will, right? And so I think there was a note from some Goldman analysts, which came out after all this, I think, which I thought was super, super interesting. They were basically saying that Nvidia recently put out a number of $3 to $4 trillion between now and the end of the decade that it would need to spend to reach its ambitious goals. And they said, I think most investors we would talk to would struggle to justify the return profile on $3 to $4 trillion of cumulative spend unless AI becomes the main driving factor in an enormous amount of the economic output of our society in some sort of end state. And that I thought was, that's a lofty, unless it completely transforms, unless it performs the way that we were promised, which transforms our lives, the way that we work, the way that we live, etc., etc. Unless that happens, investors might be thinking, no, I'm not really sure about this. However, they did say something which I thought was crucial here, which is that sometimes things reveal themselves along the way. So they said there was no way that people who were building mobile phone infrastructure could know that obviously we would have smartphones in our pockets one day that would be in such demand. There was no way that the inventors of the computer would have known that we would one day all have one. And so sometimes these things do emerge along the way, and there is a huge case to be made for this, that we're entering into such uncharted territory, and there's so much interest in this, and there's so much will for this to survive and thrive, that there could be a use case that comes out of the woodworks that we don't know about yet, that could change absolutely everything and make it all completely worthwhile in a very short period of time. We just don't know what that is yet.
Get onto what people are thinking long term, but in the sort of near to maybe midterm, how do you see the stocks looking at sort of the mood around AI sort of settling over the next little while?
Yes, I think if you look at the Bank of England, they're saying that there are certain pockets of risk that are emerging because of hard to trade illiquid assets. If you talk to investors, they are a bit concerned about the potential for an AI bubble. If you talk to OpenAI, I mean, it's making deals right, left, and center. It's made obviously a multi-billion-dollar chip deal this time with Broadcom, which sent Broadcom stock up by 10%. There is an OpenAI effect totally happening in the market. So I'm sure if you speak to companies that are involved in the sector, they go, well, we're absolutely delighted to make deals with as many Gen AI people as they would like to make deals with us, because there has a total effect on their stocks and a total effect on their businesses. However, there is a risk, and I think from my perspective, people are starting to put figures on that risk, which is never a good thing. if you're worried about an AI bubble, if suddenly people are able to predict. So I think it was CNBC was saying that the agreement with Broadcom alongside AMD and Oracle could, if it did send the AI bubble crashing down, could send NASDAQ down 78%. And now I don't know where they get these figures from, but people are banding around figures all of a sudden, which is never a good thing. If it was, today, and that was 78% down, we're looking at around $40 trillion dollars of losses, which is absolutely gigantic. What do I think? Well, I think that the companies involved are minimal in terms of it's very different from the dot-com bubble. There is a minimal amount of damage that could happen, I suppose, if everything went awry. These businesses are very experienced. They have a lot of cash. They have a lot of backing. It's a very different scenario, I suppose, from the scenarios we've seen before. I feel that this might pull on the reins a bit for these businesses who are looking to do interesting things very quickly. I think the latest example of that was SoftBank basically pulling out its investment from Nvidia in order to finance deals with OpenAI. So it's interesting because there will be knock-on effects if Nvidia doesn't have that money to then give to OpenAI. So there is it's a total ecosystem situation. It could slow them down. That would be the only thing that I think would happen, and it could make them reevaluate their needs. And I think, Sam Altman having to say, no, we're not going to rely on government funding is a very telling thing, right, at this point.
To follow on from that, that was one of the more concerning things that I think I saw that coincided with this dip in stocks. And so it raised the question of just how much debt is funding investment in AI at the moment. Do we have that figure? Do we know roughly what's going on there?
It's very hard because it's not clear, especially because OpenAI is such a big player in all of this. It's very hard to know how much is actually at play here. And so many investments have been announced even in the last few weeks, that it's very difficult to keep up. I would say there isn't an amount, but you can expect it to be very, very high. That would be my guesstimate.
Fair enough. And if we put aside for a second how an AI market might achieve this, or the AGI, or the superteller, and any of that sort of stuff, what returns do we need to be seeing from AI companies to match the input that we're seeing in investments, say by 2030?
Yeah, so we're looking at in order for them to break even and for investors to be happy, we're looking at about 2 trillion in combined revenue, is my understanding, from all of these businesses together to be able to meet the projections that are expected of them. Whether that actually happens is obviously yet to be seen. But those are the projections that are out there at the moment. I suppose with the debt side of things, already we're looking at, so Bank of America data was saying $75 billion of US investment grade debt was issued by AI focused big tech in September and October alone. So if you multiply that, let's imagine that it's been going on for a couple of years. I don't necessarily think that revenue would erase, there wouldn't be such gains to erase the debt that's accumulated. So I think we have to have different conversations about the debt. I don't think the debt is going to go away anytime soon. I don't think it will go away even when they meet the revenue demands, even when they meet the profit demands of investors. I think that debt will stay, and it will stay for a while. And that is not necessarily a problem if they're able to meet those other criteria for investors. I think that having a bit of debt is obviously something that a lot of companies have in their books, and that's absolutely fine. But as long as that debt isn't so astronomical that it's tipping over the scales, the finely balanced scales of their business. I think with Alphabet in particular, we're looking at 38 billion, right? Which is linked to Oracle. We're looking at another couple billion, right, invested in Gemini and all that sort of stuff. And then plus Google and Amazon in particular are vulnerable to any downwinds of cloud computing going down if there are any demands for that. So, look, I'm not going to back Michael Burry because far be it for me to give any investment advice. But the man's been shorting the market for what I understand is a couple of years. And he hasn't had results. So, having said that, people are saying short them now that they're down, right? You had a little dip. As soon as there's a little dip, invest because it will go up again. And I do see the logic in something like that. Not that I would do it myself, but I do see the logic in saying if there are dips like this, take advantage because it's going to go up and up, right?
To add on to the debt things as well, I think Meta also borrowed, I think it was 26 billion for a data center the size of Manhattan or something like that, which is quite a hard thing to comprehend. So if do we know what the market is predicted to make in that sort of time frame of 20 from now to 2030? To maybe they would meet that 2 trillion, maybe they wouldn't. And then if they might not, what does that mean? Because it's slightly hard to comprehend what the scale of that impact might be if there's not the returns needed for the investments.
I suppose the idea that you would have four, five, six companies in an industry do something and they all earn a huge amount of return in the same product is not something that I would expect. And I don't think it's something anyone would expect, right? I don't necessarily see how this would be any different. And so, I mean, far be it for me to say anything that involve that in any way or shape or form could be construed as investment advice, but I would say that that there is a concern over a bubble forming in the market. It is true that some of these companies absolutely could meet those demands. We don't have any projections that show how much they would all make as a cohort, as far as I'm aware. And it wouldn't make sense even if that did happen, because that would operate on the assumption that all of them would survive the competition that we're in at the moment, which is a free market. And I don't necessarily no, I don't want to be flippant about your question, but I don't necessarily think that all of them will make it. And I think anyone who says that would be disingenuous.
And if there were reports that I saw recently of about 100 megawatts of recently built data center. I don't believe that this is anything to do with the Meta ones I just mentioned. But the 100 megawatts of data center will remain unused probably for years due to the energy demand that they would have had and the grid not being there to support that. So if we take into account everything we've kind of been talking about, what does that mean for the expectation of this, the usual expectation of large capital expenditure leading to most likely, obviously stock markets are a gamble, to most likely leading to commensurate profits?
Oof. That's an impossible question to answer, Isaac. It really is. I think it is it is hard to believe that those data centers would be completely unused. I don't buy that. I think that it would be very odd that they would be sitting unused for years and years on end. I know that the energy use is a problem. I know that there are concerns over that, but I do think that the market for subleasing data centers is very, very healthy. I would be very surprised that they couldn't offload that space and that resource if they didn't want to use it themselves. I think that at the moment data centers are at a premium. I just really struggle to believe that it would not be operational for years. I really do. And if it were the case that you had a data center that for whatever reason the operating costs were so large that it would not make sense to have it, then I guess the question is, why did you build it to begin with? It's not like these have been built like 50 years ago and you're looking to rehabilitate them. This isn't an office space that you've had in your company since it began. Like these data centers have been built and they were built for purpose with projections, etc. So I'd be gobsmacked if you had a data center that was sat for years without being in any way operational. I just don't believe it. Sorry.
Oh, that's fair enough. I think there's the case of Microsoft has recently reached out to get a license to sell GPUs because it has more than it can use.
Yeah.
So there's a lot of space for movement in that area.
Absolutely, and I think that's something that it's an arena that it could definitely like get into and probably dominate as such a big business. It would make a whole lot of sense for Microsoft to start doing that, and in a sense, it would maybe be competing a bit with Nvidia, which is an interesting move for both companies for sure.
I think part of it is because they have so many NVIDIA chips at the moment that they're like, we should probably sell some of these right now while they're still expensive.
Classic.
But, and again, taking into account everything we've been thinking about, how do you think that this shock and some of it, they're sort of more, maybe it has been a bit of a wake up call. How do you think that's changed sort of people's perceptions of the rate of return on their investments in this space?
Yeah, so I think there is certainly a lot more jitters. There are certainly a lot more concerns that are being expressed, and there's certainly a lot more caveats coming from investors, and that's clear. I think where we have to pay attention here certainly is, Sarah Fryer making those comments as the chief financial officer of OpenAI. It does open some very large, doors of like question marks of what is this company thinking and how sustainable is its future for certain. And more importantly, Morgan Stanley and Goldman Sachs having that take of saying at the moment it's very difficult to see how these numbers are not super complicated and whether they actually make sense or not to investors. That is it's damning in of itself. And we've had obviously reports before that you and I have discussed from the Bank of America and Bank of England saying there might be a bubble, and this is just further rhetoric that will create those jitters and heighten those expectations from investors. It would not surprise me at all if they're looking for further investment from any of these entities, and that they come with a lot more strings attached than they might have done in the past, simply because the risk exposure just through the markets acting in the way that they did in this last week shows that it's high, right? It's still high, even with the players that are involved in this AI push. Even with the money and the resources that they have, it's still a risky investment. And so I think that risk might continue. We might see some further jitters, some further ups and downs in the market. Overall, though, I remain hopeful that just the bounce back that the markets have had, despite these comments, the reaction that, SoftBank has had towards OpenAI certainly has been encouraging. It feels like there's still a lot of momentum going behind these businesses, and that certainly if they hold their nerve, they're gonna carry on dominating this space and certainly being ones to watch within the stock market.
Well, Natasha Bernal, thank you for taking the time for the Tech Report today.
Thank you.